You're on the brink of retirement, whether that's at age 65, age 40, or even retiring early at 30. You've hustled and worked hard your whole life, built up a retirement savings, but now you're calculating your passive income cash flow, and you're not exactly seeing stable numbers. You're wondering how to get a fixed passive income stream that will continue all the way through retirement and not draw down all of your reserves. This could be from real estate investments, it could be from an index fund, but you really need that stable passive income. If your numbers are fluctuating, that's not very reassuring as you maybe quit your job and enter retirement. I'm Susan Elliott with Goodegg Investments, and on this channel, I talk about how to get into passive real estate investing so that you can work your way towards your wealth goals, passive income included, without having to sacrifice your time as a landlord. And along the way, I help you figure out a way to live your life by design now and not just in retirement. If that sounds like something you're looking for, be sure to hit that subscribe button to our channel and like this video. Be sure to stick with me to the end here, where we're going to look at some actual numbers that could be hitting your bank account with stable passive income from real estate. All right, let's jump in. To get stable income from real estate investing, you need to be higher up in the food chain. Let me explain. The food chain in real estate is called the capital stack. That's just a fancy word for who gets paid first. I've been reading a lot of those Fancy Nancy books with my daughter, so I'm really excited to use the word fancy more often these days. If you can be investing higher up in the capital stack or higher up in the food chain, your investments become more reliable and less risky. Okay, see, at the top of this stack sits the senior debt, or the bank. The bank gets paid on time every month the same amount. Below them sits the common and equity partners, or the investors like you and me. I'm a common equity investor in several multifamily deals and some self-storage syndications. We get paid after all the other expenses have been paid. That means they might be working on some renovations or have a weather-related expense to pay in order to maintain the performance of that asset. I get my preferred returns as a common equity partner, but not necessarily every month. Sometimes those accrue and are paid to me at the end of the deal. This means that even as a passive investor in these types of bigger group investments, I can't necessarily rely upon that preferred distribution return. Okay, and below that is the general partnership team in the capital stack, the very bottom. These are the owners or the sponsors in the deal, and they usually don't get any returns until the property is sold at the end of the deal. So, we want to insert ourselves higher up in the capital stack, above all of the other investors, but below the bank, because we want to pay the bank. And we want our returns to look a lot more like the bank's fixed payments, but we don't want to sacrifice that sweet upside payment we get at the end as investors. So this is the preferred equity investment. Now, preferred equity has been around for a long, long time. It's in almost every deal, but it's not really been accessible for investors like you and me until now. Okay, let's look at a visual really quick. So here's the capital stack. Again, the debt sits first. Below that, those common equity partners, you and me, and then the GP ownership. That preferred equity position right there up high, and they get paid first, right? They get paid first out of all of the other investors after that senior debt gets paid. So where do these fixed payments come from? Well, at the beginning of a preferred equity investment, an overall interest rate is negotiated in the deal. So that's known going into this. That interest rate, say 10 to 13%, for instance, gets split into two different rates. The first rate is that monthly cash flow distribution amount, that fixed, stable, lovely monthly passive income that you'll be getting. That might be anywhere between like 6 and 7%, say, of that total 10 to 13%. Now, the other percentage of your payment, so you'll get a monthly payment from that interest rate, the other percentage are payments that are going to be accruing over time and earning compounding interest. That will be paid to you at the end of the deal. This is really similar to the upside or the proceeds from the sale of an asset as the other investors might get. Okay, so let's look at that again with the capital stack. Okay, again, you have the debt, then preferred equity, common equity, GP ownership. That preferred equity is going to get monthly cash flow as well as an upside payment at the end of the deal. 2 different payments, both of them are fairly well known. Okay, you heard me say fairly well known then. You're gonna get a fixed interest rate every month through the life of the deal. You get paid first before anyone else in the deal for this. You're also gonna start to accrue a fixed monthly rate, except that rate can actually go up depending on how long we're in the deal for and how long that compounding happens. The best part is that this fixed amount, the accrued pay that's going to build and grow and given to you at the end of the deal, is not based on market dynamics whatsoever or how much that property is sold for. This is a big form of risk mitigation in preferred equity investing, and why this is such a powerful passive income idea. You get your payments regardless of market conditions, and you get paid before all the other investors in the deal. Now, I know what you're thinking. I'm an investor in some of these deals. Does that mean that I'm getting diluted or watered down? No. Typically, when we put preferred equity in a deal, at least here at Goodegg Investments, the way that we structure it, it actually makes the whole deal better. There's several reasons why this might happen, especially in the middle of a deal, but it's usually to extend the life of an already strong performing asset and be able to make it better for everyone in the end. Let's look at how those numbers might look like as they hit your bank account. Okay, say you invest $100,000. Nice round number. Your annual cash flow will be $6,750. Now, you'll begin to accrue every year a payment amount that starts around $4,300, but it's going to grow to be $6,100 by year 7. That means that in that final year, you're getting a $36,000 payment as the upside to the deal. This total return is 1.8x equity multiple. Let's look at those numbers broken down in a little bit different way, right? And let's talk about that 1.8x equity multiple. And let's do it as we walk along the beach together here. So again, you're gonna get $47,000. Those are your monthly payments totaling $36,000 as your upside, and then you get that $100,000 back to you that you originally invested. That total is $184,000. This is where we get that 1.8x equity multiple. This is just a really simple way to evaluate the potential returns of a passive real estate investing deal. Honestly, this is one of the best types of passive income ideas out there. It's based on real estate, it's backed and secured by real estate, it's fixed, it's stable, it's monthly income that's coming into your bank account, and you're continuing to grow your principal in a reduced risk way. If this kind of investing sounds all new to you, please join our Investor Club. It's free, of course, and we aim to give you as much education as possible so that you can understand all of these great options open to you in real estate investing where you don't ever have to manage properties or be a landlord. You'll also get time to talk to us and hang out with us. All right, if this was helpful, please subscribe to our channel and like this video. Even hit that bell so you can get more real estate investing info, and we'll see you next time.